Thank you for joining us on this Friday. What we are going to be discussing today is the challenges that an NRI faces. Just give me a moment. We'll be looking at the latest market trends, the key budget takeaways, the robust Indian growth projections, and of course, the currency trends that shape the investment decisions. Who are we? We have a legacy of 20 years on our side. MFA being a niche organization which has been helping its families lead the happiest financial lives possible. How do we really do it? Is by way of need-based planning approach. We make sure that it is comprehensive and personalized. Amar had founded this in 2005, and Chitra has beautifully led our organization to a 8,500 crores AUM under our management. Of course, our head office is in Bombay, but at this point of time, we do have offices in Goa, Delhi, Pune, and clients being from almost 40 plus countries across the team. This is being managed by a passionate team of 200 plus individuals. We are absolutely focused to ensure that our clients have the happiest financial lives possible. How do we do this? Because we understand that a life journey of an individual is pretty much exclusive, right? Be it a corporate who starts working in the early 20s and is at this point of time maybe worried about how to deploy the ESOPs, or maybe a doctor whose life journey, he's doing a specialization or a super specialization till the early 30s, and the earning life starts pretty much later. We strongly support independent women, business owners, celebrities, as their cash flows are pretty erratic. Our favorites being retirees who are in the distribution phase of their life and usually being sold insurance product by bankers. That is somewhere we strongly come into. Our team has been sensitized to handle families who have special needs children who need to be planning for 2 generations. We work very closely with CAs because we understand that finance has different aspects to it, whereas they'll take care of the taxation. We look at the financial planning. Today, we are going to deal with the NRIs. Our Happiness Factory platform is a fintech version by which we were able to reach out to many NRI clients of ours and their friends and family as well. What are the key challenges that NRI usually faces? We have been hearing for the longest time possible that NRIs find it difficult to be identifying an investment avenue that is in sync with their risk appetite and their financial goals. That's simply because the quality of advisory services are not in sync. They have restricted insights into the Indian markets because of the difference in the geographic and the time zones. This leads to delayed responses and decision making, which might not be in an optimized portfolio. There are obviously the fear of high taxes or double taxation as they need to abide by the norms in India as well as outside. This cross-border regulatory norms can get very overwhelming. They are worried about the repatriation hurdles as a non-compliance might lead to hefty fines and legal troubles as well. We know that our NRI clients would be usually having properties or different assets spread globally. The succession planning becomes a bit of a challenge there because transmission of wealth to the rightful beneficiary can be logistically and legally complicated. Trust, of course, since they are not residing here, and we know that most of the times the NRIs moves into the country, the bankers are ready to be selling them multiple products. There are concerns with regards fluctuation in the market condition, currency depreciation, inflation, economic and local crisis, all of it leading to concerns regarding the value and the safety of their investments. How do we come into the picture? We are supporting our NRIs in their financial journey by navigating these finances, hand-holding them through this journey. We will ensure that every rupee that comes in moves smoothly towards their financial goals. We will help you break the financial maze, which will be a absolutely personalized and a simple approach between asset classes and geographies. We understand that retirement is not the finishing line but a new chapter. And hence, with the peace of the mind, it's very, very important that you plan judiciously towards it. Staying disciplined will help you plan across family security for the continuity of the generations. We have with us Mr. Kiran Vuleti, who will be helping you with the dual taxation optimizing. We as an organization will be doing a regular reviews because we have a digital platform which can be managed and monitored from anywhere across the globe. So it's like a personal CFO that you're onboarding who will be taking care of contingency, estate, financial planning, and so on and so forth. Shruti, will you be able to help us with the first poll here? I request each one of you joining here to quickly take a minute and fill up this poll for us. I hope everyone's done this. Thank you so much. As you hear me, I am a CFA and a CFP to my credentials. I ensure that my family is able to navigate between the financial landscape, leading their desired lifestyle. I am happily joined here by Mr. Kiran Vuleti, who brings with himself a 20 years of experience in the financial services and the investment management. He has a strong track record across global assets and private banking. He has been associated with Franklin Templeton over 17 years, holding some senior leadership roles within investment management before taking up the current responsibility as the principal officer for the firm's Gift City business. He has also worked with ING Bank and Kotak Mahindra Bank, building very deep expertise in retail banking and distribution and client acquisition. I'm also joined here by my colleague, who is a senior research analyst, has been over a decade of experience into managing HNI's wealth. He has been looking into our overseas investment strategies, spanning over capital market, macro research, personal finance, and of course, the portfolio management. I welcome Mr. Karin Vuleti here to please take over from here.
Thank you, Shailja. Am I audible?
Absolutely, sir.
Yeah, thank you, Shailja and MFA team for this opportunity. And as you resoundingly said, this is a great opportunity. And also, some of your clients or prospective clients who are here, I would say that you are in the right pair of hands with MFA as your advisor. They have
Thank you.
something which is utmost important in this business is integrity, which they have in every employee of theirs that manage clients. That is something that keeps them head and shoulders above many other players that are in the market today. So their client focus is immense, and we as an organization are deeply connected with MFA for the core values that they bring in for their commitment to clients. Having said that, I'm glad to start this.
Thank you so
Let me
much, sir.
know if I can. Yeah, yeah. Uh,
It's
Let me know if the
visible,
screen
sir.
is
It
up.
is
Yes,
Yeah,
visible.
sir, it's
yeah,
visible.
yeah.
You go.
So like you started on the right note, Shelja, a lot of questions on markets. I mean, I'll start with what has happened and every Here we start with our budget. What is there in the budget? How much are we making money? Just like how each family budget themselves, the country also budgets itself. What is my earning and where am I spending that money? So in very layman terms, if you see here, we have shown what is the revenue of the country, which is the income, and what is the spend, and what is the difference between the income of the country and the spend for the past 10 years. If you see here, we have been earning X amount of money, but we are spending X plus 3.9%, 3.5%, 3.54%, etc., etc. And it just shooted to 9.2 during the COVID time, right? And post COVID, it's been gradually coming down. That means that we are borrowing as a country lesser and lesser. Now, is it good to borrow or bad to borrow? Now, it depends on where you are spending the borrowed money. So, if you look at the highlights, we are spending most of the money on things that are going to give growth to the country, right? We are seeing clearly that the growth is increasing and it's very consistent. We are seeing capex. Capex is nothing but you borrowing a house to build borrowing money to build a house, or you borrowing money to go on a holiday. So while the second one gives you a lot of joy, the first one gives you actually an asset. So that's the difference. The capex that we are spending is increased to a large extent by about 11.5%. So we are creating more roads, more ports, more airports, better infrastructure for the country by increasing spend on assets of the country, supporting our own micro, small, and medium enterprises because they create a lot of employment. And we have created a special fund to fund those MSMEs because they create employment that in future will create a lot of tax buoyancy for the country. We are spending a lot of money on railways, corridors, waterways, etc. And something which many countries do not do, what we do exclusively, is skill development, the focus on developing skills of ordinary people to make them employable. To give a simple example, many of you use in India the services of a company called Urban Company. So those people come and do household services like your plumbing, carpentry. Some of them are beauticians, etc. A lot of them are trained by Government of India in these skills. The training period is short and they give them a quick employment. So there are many other such initiatives that the government has taken under Skill India, and they have continued to do that. Now, since we have been spending money on good things, you can clearly see, if you see the graph here, the big dip in 2020, 21, where the GDP has degrown, where we were degrown by a large extent. It just started shooting up because even in when we borrowed more money in 21 22, about 9% of deficit, where did we spend? We spent on things that create impact on GDP. That's why you see that the numbers have just shot up in the year 21 22. That's because the money that was printed or borrowed was spent on creating assets and employment in the country, and that continued the growth. And that in between, due to elections and all, there was a bit of a slowdown last year in 2024-25. But then you can see that subsequently growth has started coming back again, and we are in that around 7.5%, 8% kind of range, which makes us the fastest growing large economies in the world, one of the fastest growing economies in the world. So what we call as real GDP growth is mentioned there. Nominal GDP growth is nothing but GDP growth plus inflation. So we have been, while the rest of the world is facing a lot of inflation, surprisingly, India's inflation in the last few quarters has been very low. Therefore, the nominal GDP growth is slightly lesser. But that's not a systemic thing that you need to be worried about, that we will go into that zone. Now, what is Nifty earnings growth? This is something which we all have to see. All of us invest in business for making profits, and the market gives you returns and growth when the profit of the companies grows. So we have seen that the profit of companies has grown by almost 18% in 2021, 35% in 2022. So all of you would have seen that Indian funds have given phenomenal returns in 2022 because, you know, people were thinking, oh, this is back. What is the reason for that? The reason for that, that the corporate growth in the top 50 companies in the country is phenomenal, 36% kind of growth. That is why market gave very high returns. 2023 was about 12% and 24 was about 22%. It's just that in the last year it has gone down. So if you see subsequent last 3 years, the growth was very high on an average. 25 did not meet growth expectations of the market, and that is why you have seen some correction in the market. It is not something that is to be worried about. The reason for that is because the government and the policymakers are very focused on bringing back the growth. So we have cut indirect taxes. Some of you would have heard that there has been a GST rationalization a few months ago. And how does it impact? If you are a car buyer, on a car which you are paying 28% as the GST, you are paying 18% today. That means for a person who is buying a car with 10 lakh rupees, they will either save 1 lakh rupees as cost, or they will buy a better car. So invariably, that creates a lot of demand because people will have surplus money. Therefore, we see that these cuts of tax, which happened in indirect taxes, will create demand for products in the market. The second thing is rationalization of income tax. So the income tax has been rationalized, and there is no tax for individuals up to 12 lakh rupees of income today, which is a big jump for after many many years of keeping the tax-free slab at a low level, which again means that individuals will save more money, which will either go into investment or into consumption, again creating great demand for products and services in the country. All and over and above this, RBI has cut the interest rates in the last few months, which means that buyers of homes, cars, etc., can buy these at a much lower cost of EMIs. That means not only you are saving more on cut of taxes to buy any of these products, but also the cost of money to buy such products has gone down. Therefore, combination of all these things, we think as Franklin Templeton that the growth engine for India will be revived. Demand will pick up, and it will not be instant because you are not going to save the entire money in one day. So the tax cuts happened recently, but you will see that coming into the market over the next 2-3 quarters, because there is a time or a lag for everything to show up. So we think that in the next few quarters, you will see that clearly coming in, demand coming back, people consumption going up. So the bigger things, many of you are living in, or most of you are living in foreign countries and developed countries. You know that the cost of doing business or the ease of doing business is very much high there. In India, the laws are very stringent. I heard personally many NRIs and foreign investors telling that it's difficult to do business in India. Again, on the policy front, there is improvement. We are improving the laws, making it easier for businessmen and women to start companies in India and start doing business. Labor codes have been notified, making it easier to run a company, and the number of compliances that are required for exporters by RBI, by Government of India, etc. All of them have been reduced. That means people can do business easily. So many things, these all are happening in tandem. So for a layman looking from far, they will not see it at a micro level. They'll just feel that okay, कुछ तो हो रहा है India में, or something is happening, but we don't know. But at the ground level, we see that these small things will add up to a large number. So first impact, as we see, we already saw, is that the rural demand, which has been coming down, has started picking up. So there is rural demand picking up, and many of these rural areas had demand for people working under MNREGA at the minimum wages. But in the last few years, the demand for that minimum paying government MNREGA jobs has come down. From 2020, where there was 34.9 in this graph that you can say, it has come down to 18.4. So the people want formal employment or employment in the private or public sector in India, rather than just the minimum guarantee provided by the government. So it clearly shows that there is pickup of employment as well. We can see these are various parameters that we can see, but I can tell you, how can you say that India is growing? Okay, there are various things that we look at. Monthly electricity consumption. Why do we consume more? We consume more because either people are living better lives or industries are producing more. We see that the consumption of electricity is going up. Cement production is going up. Why does it go up? Because construction activity is increasing. Bank deposits are growing. Traffic at India ports is almost at an all-time high. Okay. So these are all the things that clearly give an indication that the growth engine is coming back. So again, we can see that these are the estimates that have come for earnings of top 50 companies, and the estimates are getting better now. Now, which sectors are working? You can clearly see here that which sectors are working to. There are some sectors which have not grown. For example, in the market, the financial services in the last couple of years have grown, but in 2026, the financial services have not given much of returns. Pharma index is down, healthcare index is down, auto index is down, but we feel that all of this will be coming back in due course of time. Valuations, which is most important. How much are you buying, at what price are you buying? That is the most important thing. At any point where you are investing, you should know, am I investing at a good price, fair price, or at a bargain? So if you can see here, the dotted line is the average valuation, so that of Indian markets of top 50 companies. Basically, the price of all companies is divided by earnings of all companies, that is the profit of all companies. So historical average has been about 18.7. We had gone down below that a bit in Jan 2025, but it recovered again. Okay. And okay, we have seen that it is getting closer. So what is important is that compared to what it was in 2021 or 2022, where the valuation was much higher compared to historic average of 18.7, we were expensive by two standard deviations. Basically, in finance terms, that means it is a more expensive by about almost 4 percentage points here. Now we have come down to almost 1.5%, 1%. So if there is any correction, and either time correction or any value correction, you market becomes closer to historic valuations. That makes it attractive for you to invest. Same thing we have done for mid cap and small cap. Everywhere valuations are getting better and better. Now, if you see global markets, this is what you will ask, that I've invested in other countries. Why India has been one of the least performing countries in the world? Now, I will talk about it in detail later, but we can say that there is some amount of capital which has gone into markets that have been cheaper in the past. Therefore, those markets have done well, extremely well in the last 1 year. India is definitely not the top performing market in terms of market returns, but Korea, Mexico, Taiwan, they have given better returns. Why is this happening? The biggest trend is that AI spending is accelerating across the world, and that's creating shivers. And people think that AI will change the way we are going to live. There was industrial revolution in 1885, and then you had various other things that happened. They think this is the era of AI, and every country is going to spend, and India is also going to spend. The spend of US on AI has gone up phenomenally, and it leads the way in spending in AI spending. But we can also see that this will create huge capex growth for various countries, because AI needs data centers, AI needs power, AI needs temperature controlled environment. So all of this will mean that there is huge amount of capital expenditure that is going to happen, and that's happening in India also. So if you see again, the government has been spending, phenomenally on this capital expenditure. It was shown in the budget summary also. You can see here that the government has grown. The spend of government as capital for capital creation has grown up in India to almost all-time high of 11%, which is phenomenal. Even BSE has 500 companies have started spending more on capex, but in the last couple of years it's gone down. 23, 24, you people have spent more, but last 2 years it's been around 8%. We expect this number to go up because the demand pickup is clearly there. We have seen market volatility primarily because of outflows in September 2024. We've seen close to 29 billion of outflows from Indian markets pulled out by foreign investors, while the domestic investors have been pumping in money. So, we due to the outflow of foreign investors, two things have happened. Market remained a bit volatile, either flat or low returns, and currency has also taken a hit. Uh, this again is another repetition of the previous one, where we see that we have compared ourselves in terms of valuation with Indian historic valuations, but we are comparing with other emerging markets. So if you see, we are now close to MSCI, other emerging markets in terms of valuations. So it becomes very natural. But if you see, in some parts, India had become much more expensive than the rest of the emerging markets. Therefore, money had gone to those emerging markets, and now we are coming almost close or similar valuation as other emerging markets. Gold and silver price trends, I mean, many of you seen it. Uh, Gold and silvers have been moving up, but again, long-term trends, if you see, gold has been consistently going up over the last few months. So crude has remained flat in the last few quarters. So the last point that I would like to say that is that there's been a big shift in the way Indians save. Thanks to people like MFA, the awareness of financial products has increased, and household savings of India, which used to be roughly around 3% in equities, is gone to 6.6%. The Indian household, average household, has got that much more skin in the game in compared to anybody else. If you see here, 10 years ago, 3.7% of Indian household wealth was in equities. It's almost 300 basis points more at 6.6% of Indian wealth in equities. We expect this number only to go up. Property remains at 50%, gold at 17.5%. Still a long way to go before we come anywhere near developed markets. But it clearly shows that there is massive financialization happening in the country, and people are willing to take that risk and participate in equity markets. Uh, I'll stop here for a second. And any questions, or do you want me to go to what is Gift City?
I think we can move ahead with the gift city, Kiran, and
Yeah,
then we'll take
sure,
the combined questions
We'll
in
take
end.
sure,
the questions at the end. Yeah.
sure. I mean, gift sounds very good. Everybody thinks, what is this Gift City, etc. Good. Gift stands for Gujarat Information Fintech City. It is the first operational smart city in the country. It's a special economic zone. It is in the state of Gujarat, in the city of Gandhinagar. Uh, it is like some of you who are living in Dubai will know what is DIFC. Similarly, there are many other people who are living in other countries which have special economic zone for free movement of foreign capital. So, government of the day felt many years ago that it is important as the country grows that Indians also have a hub which allows free flow of capital into the country and facilitates Indian companies or Indians investing globally. So Gift City was started with that intention, and there is one single regulator for all entities in Gift City called IFSCA. Within that one regulator, you have banking, insurance, capital market, leasing, fintech, etc., etc. But it is everything is under one regulator. So if you can see here, most of the large companies, especially in the finance space, you can see that they have already started coming into Gift City, and they are doing business here. What is Gift City? How does it matter to NRIs? See, for many years, there's been a big challenge to India, that India is one of the very few countries that taxes foreign investors in markets, and people wanted an avenue where they can easily enter into Indian markets with their dollar capital or any of the major currencies in the world, and invest in Indian markets seamlessly. And many of you would have seen that the KYC process for NRI customers, especially for some of you who would have surrendered Indian passports and taken some other country passport, is quite a challenging thing to participate in Indian markets. You need a PAN number here, you need to find ITR returns, etc., etc. Now, Gift City creates a platform where all these have been smoothened out. You don't need a PAN card, you don't need Aadhaar, you don't even need a bank account in India. You don't need to, if you have a company to invest, you don't need a FPI license to invest in India. It becomes very easy. You can invest with your ID proof, which is your passport and your address proof, and with your bank account in whichever country it is in. For the money that comes in, there is no conversion at a fund level. It gets invested in dollars. You can take back the money in dollars without any TDS, TCS, capital gain levied. You pay tax in the country that you reside in. You don't need to file any ITR. So this helps you to bring in money seamlessly, and there is no restriction on repatriation. You today what happens is, you want to invest in Indian market, you need to have an NRE account or NRO account. You put money in that account, transfer it into through Swift, convert into INR, then invest, and for that you need to have a KYC in the domestic area, and then you invest in the fund, and when you take back there is a TDS component, and then when you want to take back the capital, the bank has certain formalities which need to be fulfilled, which is not a smooth process. All those things do not exist if you invest through Gift City. You invest in dollars, your money is invested in the same funds that you invest in through the domestic route, and you can take back the money in dollars. No questions on TDS, TCS, income tax, all those things will not be there. For you, it is a free flow of capital. Now, this is how it works. What we do is, people like you who are abroad, not just in individual capacity, but some of you might be businessmen or businesswomen. You have your company but that might have some surplus funds. You want to invest in India, but because you need to come through FPI route, you wouldn't have taken exposure to Indian funds. But if you want to invest in India, now there is an option for even corporates and non-individuals like a family trust or a family office to invest in India through Gift City funds. You invest in a feeder fund in Gift City, which invests in the master fund in India. So it's seamless. You invest in the same fund. When you take back the money, the master fund in India doesn't deduct any tax. It keeps pays back full amount to my feeder fund in Gift City. My feeder fund will convert it back to dollars and pay you back. It's as simple as that. You pay tax at an individual level in whichever country you are in. Some of you are in countries which are having no domestic tax, capital gains tax. For them, this is the best route. You don't need to file Form 10F to get exemption if you have DTAA. Some of you do are live in countries which do not have DTAA, in which case you end up paying capital gains tax. So, in people who are in non-DTAA countries also can take advantage of zero capital gain by investing through Gift City. A little bit about Franklin Templeton. We are one of the largest global asset managers. We are the largest cross-border asset management company. So that gives us the experience and expertise. We have close to 1.69 trillion dollars under assets under management, and we Gift City is our latest venture. We started in 2025 May, and we have started offering products from here. So we have the expertise as the largest cross-border asset management company in the world, and we're happy to partner with MFA and bring you very innovative products through Gift City for all NRIs. I'll stop here, and Anil, Shelza, if you want, I'll take any questions.
Sure. Thank you so much, Kiran, for that presentation. I think that was really helpful. You taking us through the high frequency indicators, which kind of tell us that, okay, despite whatever we have been hearing globally, despite, geopolitically, whatever the situation may be, if we look at the core fundamentals, these are very, very strong. Even if you look at GDP, inflation, and you have kind of highlighted all of these very nicely in the presentation. So thank you very much for that. Also taking us through the Gift City, which is quite an innovative, initiative. Participants will take questions. If you have any questions, please put in the Q&A section. While you put in, we have received some questions, at the time of registration. So I'll kind of take those, Kiran, and if you could answer those, that will be great.
Sure.
So one of the so there were many questions, and one of the common ones which we have been which we got were, compared to other markets, which we all have been hearing that did good in the last couple of years. And of course, against that, India has been kind of, if not falling, been flat. So does it even make sense to kind of put money into Indian equity markets, when all of these things are happening around us geopolitically?
Very good question, Anil. And I think we keep discussing this as you as advisors keep asking us the same question, and we have to show it with data. So I'll show you. This is actually the comparison of many major indices in the world. I have Nifty China, which is Shanghai Composite, S&P 500 US. We've also put another emerging market, Brazil, as a reference point, but we also put emerging markets and world, okay, in different colors. Now, if you see, Nifty has done phenomenally well, and especially in the last 10-15 years, it's grown tremendously. The line in blue, which is if you tail back from here, it's grown tremendously over the last, from if you see from here, we've started outperforming from 13, 14, and then it just took off. And for a moment till 23, 24, we were ahead in dollar terms, even when compared to S&P 500.
Yeah.
It's only in the last couple of years that this gap has come up. Despite that, we remain the second best performing market. If you see, these two are breakout lines. The top one being S&P 500, which is US markets, and I mean, most of the investors and across the world, we have seen, including Indian investors, are invested in a US market in some way or the other. There are US funds in India. There are some people who have, accounts, demat accounts with or trading accounts with foreign brokers, and they invest in ETFs and American stocks. So US is fairly well known market, and many of them have invested there. You in the other scenario where India is hugely underinvested, despite us being one of the largest economies in the world, we've not got the kind of capital that we deserve to get. And I've mentioned to you that there's a very long decadal opportunity that we can see,
Yeah.
that the government is spending money on capex, assets are being created, which will create a platform for growth. And we are all seeing many people, NRIs, who would have come back and would feel that every time, a couple of years they come, they see something new in India. I see in Bombay people start raving about the coastal road and the new metro. In Bangalore about the new airport terminal. Hyderabad, everywhere you can see that there is some landmark project or there's some big development. All this will start showing returns. It's not an instant tap,
Correct.
and this is again another opportunity. I'll go back and say that you have to invest when the valuations are getting softer. And it's a good opportunity. Over longer term, we still feel that India is a great opportunity, one of the best investment destinations in the world.
Absolutely, absolutely. Thank you so much. And just to add to that, I think one of the major, and you mentioned in one of your slides also, that one of the major reasons for the Indian markets to kind of be at the same level in the last 2 years is that a lot of money has gone out, like in terms of the FIIs pulling out money. And I remember that we have seen such a situation back in 2007 and 8 when GFC happened, the global financial crisis happened. And that time when such amount of money went out, markets went down by more than 50% in India. But today, despite more money going out, also we are still maintained the kind. I mean, the same levels that we were back in September 24. Largely, I mean, thanks to the domestic investors' participation that we have been seeing post COVID. I think that is phenomenal, right? Correct me if I'm wrong, and that has really kind of contributed to the resilience of our Indian equity markets.
So that I've shown in the previous slide also, Anil, that the participation of Indian investors and their
Yeah.
assets you can see that it has moved from 3.7 to 6.6, okay, which
Absolutely.
is a big jump. The financialization of savings, and this is on a larger base, is very, very big. Okay, and thanks to people like you, that the awareness has increased, and younger people want to invest in the markets and not just in traditional assets. Uh,
Correct.
Clearly, we see that trend getting better and better. The
Correct.
6.6 is only going to go up. The other point, Anil, which I alluded to, is the returns. All of that was in USD terms.
Lovely.
Okay, despite all the volatility in Indian currency, the Indian markets still remain the second best performing market over a long period of time in the world.
Absolutely, and that also takes care of the currency, common currency kind of returns. But I will
Yes,
come to the
yes.
currency question later that we've got from the clients at the time of registration. One of the
Mhm.
questions that we have in the Q&A is Yogesh Deshpande is asking, I have currency exchanged and capital in INR in my NRI account. Can I invest from this NRI account into Gift City funds? And what are the returns expected in these type of funds?
So these are yes, you can invest through your NRE account in Gift City funds. That's a easy one to answer. Returns, see, you have seen many of you would have participated in Indian mutual funds. Even if you take long-term depreciation of 3% of currency in USD, if Indian funds are giving, say, 12 to 15, 16% returns, you also expect 2, 3% to go off. So you are going to get same, at 12 to 14% kind of returns in these funds. So, and sometimes it could be less, sometimes it could be more. If you invest when the valuations are low, you will make higher returns. If you invest when your valuations are high, you make lesser returns, but you average out, do an SIP kind of a thing, you make better returns.
Perfect. Got it. Another question coming in from Vineet Iyengar asks, is there a minimum investment size to participate?
Yes, what currently we have is a category 3 AF, which is a pass-through vehicle that we created in Gift City. You invest in that AF, the minimum investment is $150,000 for normal investors and $50,000 for accredited investors. Accredited investors are investors with an income of $200,000 and above, or with a net worth of more than a million, with at least $500,000 in financial assets. So those investors can start with $50,000 also.
Perfect. Next question is from Ramesh Seshadri asking, Gift City takes care of many issues, tax, repatriation, KYC, but currency depreciation is still a risk issue. Are there any Gift City products that take care of currency depreciation as well? I think that's a very common question that we have been getting, and if you could kind of take us through this in detail, would be great.
Yeah. So see, theoretically, like we discussed, Anil, that
Yeah,
currency depreciates because of inflation differential. But if you see over the past many years, the difference between Indian inflation and global inflation has been only narrowing. Therefore, our currency, if you see, like this year, it's been sharp. But if you see over the past 10 years, it's depreciated by about three odd percent. Now, I keep telling people that yes, this may not change immediately, but if you are investing for 5, 10 years, assume that you are going to lose 2 to 3% due to currency depreciation. And if any upside comes as a surprise, that's great. But you start with the assumption that you are going to lose some value because of currency depreciation. There is an option to launch a share class which is popular globally called hedged share class, where we hedge currencies, but it doesn't make any sense in equities to do that. It makes more sense in fixed income to do that.
perfect. And just to add to that, I mean, we kind of have these multiple conversations with the client when we are doing the planning, overall goal-based planning for our clients. And currency is one of the biggest factors that we kind of take into consideration. Now, this is very common that, okay, what has happened in the recent past. So if in the last 6 months or in the last 1 year, if we see that INR is depreciating massively, that kind of gets stuck in our mind. Okay, if INR is falling down by so much, maybe it doesn't make sense to put in India. Even if the Indian equity markets give me good returns, I'll be net, I'll be zero only. But that is something which is only in the recent that we see, and we only look at the absolute numbers. If I can just share one more, data point, I'll just share my screen. If we look at the longer term data points, so over here, the C column, which tells us that okay, this is INR against US dollar. So although in the last 1 year it could be 4.5%, but if you look at longer term, like 3 year, 5 years, 7 year, it has maintained this depreciation level, which is about 3% or 3.5%. More importantly, if we look at euro and GBP, that is where we are getting maximum queries that okay, they have appreciated so much in the last 1 year, which is true. That euro has gone up by about almost 16%, GBP has gone up by almost 12% against INR. But if we look at, we are not investing into equity markets for only one year period or 2 year period, right? The nature of equity is such that we are investing for the longer term. Therefore, if we look at the longer term trajectory, we have to look at the annual depreciation of INR against these currencies. So if you look at, let's say, 10-year period, INR has depreciated by only 3.23% per annum against INR. Same goes for GBP also, which has which has appreciated by 2%. That tells you that okay, even in the short term, and by the way, currency is one of those things which kind of fluctuate a lot, and there are so many factors which kind of come into picture. Talking about currency, it could be changes in the price of oil, geopolitically something happening, something war kind of situation happening in one part of the world. All of these things will kind of have an impact on the currencies in the short term, because people do react on the basis of what we are hearing around us. But ultimately what happens is, if one country's inflation is, let's say, 2%, for example, and another country's inflation is about 4%, then the country with 4% inflation will depreciate by 2%, which is the difference between these two inflation. And that is exactly what happens with every country's currency in the longer run. But that doesn't happen in the short term, because short term people do react, and therefore currencies kind of fluctuate widely. But it is very important to factor this thing in the overall planning while we are doing the goal based planning, and say okay, if we need X amount of money after so many years, and this is the kind of returns that I can get, if let's say we are having an assumption of getting 15% from Indian equity market in the long run, and then against that we should say okay, 2 or 3% will be the INR depreciation, which means net net, if I'm getting about 12%, am I getting that 12% from the country where I live, like be it UK, be it Europe, or be it any other country? If the answer to that question is no in the long run, then it definitely makes sense to put in India, even despite what we have been hearing, because the fundamentals remain intact. Yeah, and that was one
Well,
of the
well said, well said, well said, Anil. I mean, we have seen that even in market, the returns don't come in a straight line.
absolutely
Similarly, the currency also doesn't depreciate in a linear way. There will be, if you have an inflation differential and you don't appreciate it or depreciate for 2 years or 3 years, it is likely that whenever the correction happens, it may be very sharp. That is what has happened in the case of INR.
correct. Absolutely. One more question that we have got is about the tariff. So, although we have seen the tariff deal happening with the US and Europe as a region, um, is there something to kind of worry about, not knowing the details so far, or should we kind of assume that okay, things are now looking even better what they were looking 6 months back? That's the question that we have been getting.
Yeah, Anil, so I would like to also say that why should we be worried about tariffs, right? 80% of the profits for Indian companies come from domestic market. Okay,
Absolutely.
and majority is domestic markets. How much is our exports? And how much of that is depending on US, and how much of the profit comes to there? In fact, I might have some data point. I'll see if I can dig it and show it to you. That it's a very, very small impact. And tariffs have, I would definitely say, have impacted. At the same time, it's not that tariffs have killed everything, right? We've gone back to the US drawing board, and we are now back with US at a better tariff. And the market also understands that, yeah, I have this number. Okay. Let me know if you
Sure.
can see.
We can see the screen now.
So this is the top 500 companies revenues. Okay, exposure by region. 80% is India. Okay. Only 5% is US. And how this is on the revenue side. And a lot of it is exports of software, okay,
Mm.
which is not tariffed, and pharma is not tariffed. The
Hmm.
guys who are getting more impacted by tariffs are specific industries, whether it is textile or diamonds or jewelry, etc., etc. Most of the other industries are not impacted by tariff. The current volatility, even in the tech space, is got more to do with the AI revolution than tariffs. Nobody
Absolutely.
talks about tariffs. Maybe the visa, all those things are not a big issue today. The biggest issue is for the tech space is evolution of AI. Also, you should understand that people who have visited India in the recent past, there's a quiet growth of what we call as GCCs, Global Capacity Centers. Like as Franklin Templeton started a huge setup and in Hyderabad 20 plus years ago. Uh, so roughly about 30% of our 28% of our workforce, global workforce is in India, and a lot of them in Hyderabad. They do a lot of work for the entire world. Similarly, you would be surprised to know that JP Morgan has more than 50,000 employees in India in their GCCs, and they are not
Yeah.
the largest. And they are not the largest. There are GCCs in India which employ more than 100,000 people,
Mm.
which is a huge growth, phenomenal growth that has happened over the last 4 5 years. Again, kudos to the policy. Very few people understand that it is because of policy decisions and changes that this revolution has come in India. Okay, while there is some slowdown, definitely in the IT space because of this AI, etc., it has been more than offset by GCCs, cushioning that growth.
Perfect. Very, very interesting in terms of the tariff that you shared. That large part of it comes from India, and that takes me back to yours one of the slides where you mentioned that in the recent past, the reforms which India have kind of taken, such as GST rationalization, cutting the rates of GST for many products, not just the cars, and that will really increase the demand within our country as well. So that somewhere, to a large extent, kind of offsets if there is any impact of tariff that we are talking about. So that's a good way to look at it.
Absolutely true, Anil. And many investors or some of the people who are here from different countries would have realized that when they come to India every other year, they also see improvement in quality of life for many of their relatives.
Right.
You hardly see any hatchbacks in the country. It's predominantly SUVs and stuff like that. Uh, People live in air-conditioned homes to a large extent. People consume more and more luxury products. These are things that have happened over the last 5 10 years, which is actually become an habit to it. And for people who come after 3 4 years, they suddenly see that what is this that has happened in India. So there's huge amount of premiumization or quality consumption that is happening in India, which is changing the way Indians make products and services. That is adding, and these cuts of GST will only add value. And in my interactions with dealers or some of the businessmen who are in the business of automobile, when I ask them that are clients buying cars with a X budget, if you had a budget of 15 lakhs to buy a car and you are saving 1.5 lakhs due to GST cut, are you buying a car with 13.5 lakhs, or you are buying a higher version of the car with 15 lakhs? It was more so that people are consuming that they are buying a higher end of that model and spending that extra buck. And same thing in all uh, 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 all items that we consume, in whether it is in real estate. I have not seen a hoarding of affordable housing in many years now. I don't know if you have noticed. 10 15 years ago, every city in India used to have hoardings of affordable housing. Now I only see premium housing. There
Right.
is no affordability. Everything is premium.
Perfect. I think absolutely, and that really, I think we don't have any more questions. Thank you so much, and that really kind of increases our belief in India's growth story again. We just have to kind of go through this range-bound market phase wherein the markets are going up and down, and we have seen the volatility in the market. but we have also seen that in the last couple of years the valuations have come down, and that is really really good. I just have one more last slide before we kind of close today's session, just for the participants to know that okay, even if the markets kind of go down, whenever the markets have gone down in the past, they have bounced back very nicely. And if you look at the orange bar over here, these were the periods where the markets had gone down, and we can see that markets have gone down about 57% also, 52% also, 37, 50%. All of these were the drawdowns or the crash kind of situations in the past. But after those crashes also, or after those dull periods of performances in the Indian equity market, we have seen a huge amount of recovery. Not just the recovery, but we have seen that markets kind of giving very good returns, and that is what the nature of the equity markets are. That equity markets will always remain volatile, and despite the volatility, it makes a strong case to kind of invest in the Indian equity markets. So thank you so much, Kiran, for taking us through your presentation. That was really, really good. Shelza, if we can share the slide where we have the contact
Shruti,
details.
we have to take
We'll take the
another
poll.
poll, Shruti.
Okay, huh. So we'll take the poll first. Hmm. Yeah. Thanks to Shelza, can you share the screen where we can have the contact details?
Okay.
Participants, you can reach out to us for a session, for a discussion about the goal-based planning. And if you have any questions that comes to your mind, whether it is about market, whether it is about coming back to India, thinking about a goal, all of these. So these are our contact details that you can note.
Thank you so much, sir, for joining in. We
Yes.
Thank
understand the
you.
NRIs are grappling over the opaque FEMA guidelines and the shifting RBI rules, but you made us believe that Indian markets remain resilient still. Thank you so
Thank
much.
you. Thank you for all the participants and team MFA for putting this together. And as always, we're always available for at your service to help you navigate all these hurdles for investing through Gift City. Thank you very much.
Thank you so much. Thank you.